Good afternoon, everybody. Good afternoon. Got kind of an unruly crowd here today. No, I'm just kidding. But my name is John Bitson. I'm the Menard Family Director of the Sheila and Robert Challey Institute for Global Innovation and Growth. And welcome to our Menard Family Distinguished Speaker Series. I'm really excited that today we have Douglas Duncan, Senior Vice President at Fannie Mae. I'm excited to be here in Bismarck as well. Doug was telling me that his brother lived in Bismarck and then decided to move out of town when he heard that Doug was coming to speak. I'm just kidding about that. But anyway, so I'm super excited. You'll get a chance to ask your own questions at the end of the presentation, so please get your questions ready. Douglas G. Duncan is an executive advisor and senior vice president at Fannie Mae. He was previously senior vice president and chief economist at Fannie Mae, where he was responsible for forecasts and analyses of the economy and the housing and mortgage markets. Duncan also oversaw strategic research regarding the potential impact of external factors on the housing industry. Under his leadership, Fannie Mae's Economic and Strategic Research Group earned the 2022 Lawrence R. Klein Award for Blue Chip Forecast Accuracy, recognizing their industry-leading work over a 4-year period. In both 2015 and 2016, Duncan and the ESR Group won the National Association of Business Economics Outlook Award, presented annually for the most accurate GDP and Treasury note yield forecasts, becoming the first recipient in the award's history to capture the honor for 2 years in a row. Named one of Bloomberg Businessweek's 50 most powerful people in real estate and Inman News 100 most influential people in real estate, as chief economist, Duncan was Fannie Mae's source for information and analyses on demographics and the external business and economic environment, the implications of changes in economic activity on the company's strategy and execution, and for forecasting overall housing, economic, and mortgage market activity. Prior to joining Fannie Mae, Duncan was senior vice president and chief economist at the Mortgage Bankers Association. His experience also includes work on the Financial Institutions Project at the U.S. Department of Agriculture and service as a LEGIS fellow and staff member with the Committee on Banking, Finance, and Urban Affairs for Congressman Bill McCollum in the U.S. House of Representatives. Previously, Duncan was a board member of the National Association of Business Economics and a board member and chairman of Strategies to Elevate People. Duncan is a Hoyt Professional Fellow at the Homer Hoyt Institute. He was chosen as the North Dakota State University College of Agriculture Alumni of the Year in 2018. He was also elected as a trustee of North Dakota State University in 2022, and he just won a Distinguished Alumni Award for Lifetime Accomplishments from NDSU as well, so congratulations on that as well. I probably got the title of it wrong, but congratulations. Duncan had received his PhD in agricultural economics from Texas A&M University and his BS and MS in agricultural economics from North Dakota State University. So thanks to the Menard family and to all of our donors for making this possible. Really excited for the conversation we're going to have. Let's all please welcome Dr. Douglas Duncan.
Thank you. Thank you. It's great to be here.
Yeah, thanks for being here. Appreciate it. Yeah, and so maybe just before we start going through some of the you sent a bunch of very interesting figures, which I'm excited that we're going to talk about. But you were telling me just about how you got your interest in economics. So I think it'd be kind of interesting for everybody here just for you to tell your story about what made you interested in economics in the first place.
Sure. When I got out of high school, there were no colleges waiting at my door because I'd asked my father what kind of grades I had to get in order not to get in trouble in high school. He had never graduated from high school, so he said nothing less than a C, so I nailed it. And so I went to the local community college for music and drama, and Broadway wasn't waiting either. So I went in the Navy the last year of the draft. I enlisted. While I was sailing on the USS Lexington, started reading Newsweek magazine, and every other week, Milton Friedman and Paul Samuelson, both of whom are Nobel Prize winners in economics, wrote columns. And I don't know why I started reading that in particular, but I just got fascinated by the idea that you could reach that level of accomplishment and yet have such different ideas on how the economy worked that I decided I'd become an economist. I didn't know what you'd do with it, but that's how I decided. So I got out Minnesota. I grew up in Fergus Falls, Minnesota, which is obviously near Fargo. And my older brother had got a civil engineering degree from North Dakota State. And so I went there and took advantage of the tuition reciprocity as a Minnesota resident. And the rest is history.
Yeah, well, and you've certainly done a lot with economics, and we're grateful that you're here with us tonight. Just one other story, you told me this, and I just think it's very great about he's very accomplished as an interviewee, so could you just talk about your first interview that was on CNN? I think that was a great story as well.
Well, we were talking about Milton Friedman saying that if you can't explain something to your mother, that she would then understand that you don't actually understand it yourself. So I was at the Mortgage Bankers Association, and they'd had a management change. The entire management committee left, and I was one of 3 people that were promoted from within, and I had never done an interview of any sort. And CNN called and wanted to do an interview, and so I had no training or anything. So I went over to the communications department, and the comms director had been fired, and so there was a temp there. And I said, "What do you think? I should do this?" And he said, "I don't know. I'm a temp." And so I called the member president, who is Andy Woodward, the CEO of Bank of America Mortgage, and asked him, "Do I have to do this?" He said, "Well, what'll happen if you don't?" And I said, "Well, they'll probably say we refuse to comment." He said, "Then you're doing it." So I got in the cab to go to CNN, and I'm trying to figure out, how will I know if I'm credible? So I called my mother, who still lived in Fergus Falls, and I said, "Do you get CNN?" And she said, "We get cable in western Minnesota," which means I'm in trouble. So I said, "Well, would you watch this show? And then I'll call you and tell me how I did." So I did the interview, get in the taxi on the way back. I call her. I said, "Well, what do you think?" She says, "Get control of the eyebrows." I said, "What do you mean?" And she said, "I didn't understand anything you said, but the eyebrows are all over the place." So this is your mother concerned about what the relatives are going to think. So that was my first interview, true story.
Yeah, that's awesome. So Doug sent a bunch of different figures to lead our discussion, and so thanks for sending these figures. I think they're extremely informative, and you see the one that's up here right now, and it's showing that for the last 40 years, we've had pretty low inflationary expectations, which have led to low interest rates. And so some of the things that are important, obviously, are demographic trends, that the baby boomers were reaching the peak of their earning years during this time period. We had oil exploration and the ability to harvest it through fracking technology, other important technologies related to the internet, the World Wide Web, the texting, the iPhones that you highlight, the openness to international trade. China joins the WTO in 2001. A lot of things that have led to this low inflation environment, really increasing our productive capacity to produce more goods and services cheaply. And so in 2021, we started to experience some inflation. I mean, I know that the inflation was helped along by a lot of government spending and a lot of Fed actions to deal with the fallout from the pandemic. But do you think we're in for a new normal where we're going to, should we be expecting, higher inflation rates, higher interest rates in the future?
I do think we're entering a different regime. So if you look at that, that's the 10-year Treasury yield, and that reflects the career of anybody that's in this room. It started in 1978. That's actually the year that I came to NDSU. 1978 was my first year at NDSU. It was also the year that the Humphrey-Hawkins bill, which gives the Fed its dual mandate of employment and level prices, and Paul Volcker was appointed. So a really big year at the end of the 1970s inflation, and those things started this gradual disinflation of the U.S. economy. So that's across all of your careers. I remember sitting at my desk in June of 2003, and I had the CNBC ticker going, and the 10-year Treasury hit 3.1%, and I thought to myself, will I ever see a 10-year Treasury rate under 3.1? Well, we did. We saw 0.51 at the bottom of the pandemic. Unlikely that we'll ever see anything like that again. So in today's environment, the number one question I'm getting, it relates to exactly what you're suggesting. People are saying, well, the Fed cut rates, why did interest rates go up? It's a pretty reasonable question, and there are probably several potential answers, which one thing Graham, the great investor, had said that in the short run, markets are a voting machine. In the long run, markets are a weighing machine. So what you see in the market today is a vote, and it's a vote that conflicts between several things. One possible outcome is that people think that the Fed cutting the federal funds target rate means that economic growth will strengthen, in which case investments further out on the curve have greater value, so you could borrow to make those investments and get a good return. Another group of people may say, well, the Fed's cuts are premature because they haven't conquered inflation yet, and if they cut rates, it's going to raise the potential of inflation because they move too soon. Another group might say, well, we've been watching the election, and neither candidate has paid much of attention to the level of debt that's going to accumulate. And we're asking the question, will investors have to receive a higher yield in order to be willing to lend money to the U.S. government for that longer time frame? Which of those is the dominant factor? I think the weighing part of the market will sort that out over time. But in the near term, we've seen not only rates, but also some spreads increase. In our view, the inflation is not yet conquered. And what we asked was, what was the rationale for cutting 50 basis points in the first cut? And I assume all of you watched the Fed press conferences. That's the equivalent of an economist cocktail party, which is probably the reason you don't go to economist cocktail parties, right? But we're all there, and so on my staff and I were watching, and we're asking, what's the rationale? And there wasn't a strong rationale that was given for why 50 basis points was merited, because really the market was more attuned to a gradual move, reversal of the focus of the Fed with regard to inflation. And 50 was a surprise to some degree to the market. Following that with another 25, and now you're starting to see some discussion again in markets in whether or not the Fed, which had sort of indicated another cut in December, will in fact cut. And there's more discussion about whether they will make more cuts at all until maybe the middle of next year. So there's really a significant amount of uncertainty that has come back into the market over the last month or so. In terms of the direction. Our view is that you will see rates running. We tend to start with the mortgage rate, but underneath that, the 10-year Treasury, somewhere 4.25 to 4.5, getting you to a mortgage rate around maybe 6.5 for some time. We do feel strongly that this level of debt is, under the federal government, is a challenge for markets.
So it's interesting when you talked about the economist cocktail party, you've heard that an economist is somebody that likes numbers but doesn't have the personality to be an accountant. I'm sure you've heard that joke anyway.
I used that at the AICPA bank accounting conference. There's 1,000 accountants in the room, and I used that. The room went silent.
Yeah, they don't think it's so funny.
Then I said, well, I'm never sure who gets insulted by that. Yeah. Then they all laughed. Yeah. You know?
So looking at some of the longer term things, I'm just like highlighting the things that, demographic trends and oil and all those things. I mean, are there things that just long-term that we should be doing to try to, keep as much tailwinds as we can behind this lower expectation of inflation, interest rates in the future? I mean, things like, we know that like the baby boomers have retired, and so like reform immigration policy, be more open to international trade. Are there, cut regulations, I guess. Are there things that you think that we could be doing to kind of prevent the headwinds that are coming in the future?
Yeah, I think the hallmark of the U.S. economy has always been entrepreneurial innovation. So North Dakota has been a beneficiary of fracking technologies, which were unknown 30 years ago. And there was lots of discussion about has the world reached peak oil so that it's going to be a dwindling resource? Well, nothing could be further from the truth. The advent of fracking has changed the whole world outlook on that. In fact, the U.S. is now both an exporter and an importer of oil. North Dakota is one of the key pieces of that. You think of sand, which is essentially silicon, of which we make chips. You can go back another 15 years or so beyond that. You can see it up on the time chart where now the iPhone that you carry in your pocket with those chips in it has the much greater power than the largest computer that was in place 30, 40 years ago. Yeah. In fact, I was at a private event where there was a 4-star admiral from the Navy and a rock guitarist who is actually under a security agreement with the National Defense Association because he was writing things about wave theory and how it might impact things like drones and things like that. And he held up his iPhone and he said, you can actually, if you know what you're doing, shut down parts of the electrical grid with your telephone. Oh. So it's a completely different world today. I think that will continue. I think there's the artificial intelligence discussion is one that will be explored. I always remind people in the world of technology that Google was the 7th search engine that was introduced. So there's sort of the bleeding edge, and then there's the leading edge, and then there's the flourishing of some technology. To go back to 2000 with the dot-com meltdown, think about that for a second. If you want to understand that event, you might read a book by Stephen Ambrose on the building of the Transcontinental Railroad. The story of the Transcontinental Railroad has to do with the credit mobilier scandal in the Grant administration. I'm sure you all remember that from your high school history classes. Well, what that was there had been stock speculation in the railroad stocks that was used as capital to get the financing to complete the building of the Transcontinental Railway with the pounding of the spike in Logan, Utah. But just having one band of steel go across the country wasn't sufficient to create great economic value, and so the stocks collapsed. And that was the scandal in the administration. However, 20 years later, when refrigerated rail cars, comfortable passenger cars, all the trunk lines into agriculture and meat production had been built, all those stock valuations came back. So the early stages of some innovation often don't reveal what is ultimately going to be successful. So the 2000 dot-com meltdown, what came out of that? Google, the iPhone, you can go down the list of things that were successful, but all that capital flowed in, and some of it found that something might be technologically feasible but not economically viable. Something might be economically viable if you could make it technically feasible, but it wasn't. Some would be neither technologically or economically feasible, and some would be both. But that capital had to flow in to explore all of those options until we found what are the solutions that are going to create new economic value. That's what makes me optimistic about the future of the country, and all we have to do is keep in place the incentive structure to those entrepreneurs to be willing to take the risks, to deploy the capital, and explore those opportunities to add to our growth. So I think those things can be done. You mentioned regulation. A couple of us were talking about the Chevron case that took place in the Supreme Court recently. The incoming President Trump has said one of the things he wants to focus on is deregulation. If they pair up what was decided in that court case, where it's not the administrative agencies whose word is going to carry the day, but what's adjudicated in the courts, I think that will free up additional innovation and reduce regulation and be of an assist to growth.
Awesome. So are you okay if we go to the Magnificent Seven diagram? Because I think this is a good way to, could you go to the, we'll go back to this in a second. Could you keep going until it says Magnificent Seven?
There.
Oh, right here, okay. So this one just shows how the Magnificent Seven tech stocks, like Apple, Google, Microsoft, and then NVIDIA, who's the AI producer, how they've kind of driven the stock market. And so given your optimism about innovation and that being the thing that's going to carry us through, what do you think about, so if we think about artificial intelligence, tremendous potential, things like speeding up the discovery of drugs and finding new cures and really making people in very, very skilled professionals much more productive in their jobs and being able to produce more goods and services. So do you think it's that, and then there's people on the other that are worried about like privacy concerns or, ethics of using AI and a bunch of different concerns. So do you think that it would be a good idea to weigh on the side of saying like, let's not worry so much about privacy and these other things, that it's such an important thing that we need to just have a light touch regulation to make sure that the U.S. is a leader in this for the future? Or what is your thought on that?
Well, it's usually the case that markets run ahead of regulation. So any new innovation gets out into the market and well before there has emerged a set of things which will ultimately generate regulation. I'm not of the view that no regulation is an appropriate amount, because I think we have benefited from some of the health-related things through the USDA and some of the things in the medical field protecting and making sure that side effects are understood and those kinds of things. However, I'm more of a light touch regulation kind of person. I think on the artificial intelligence space, I divide that into two components, AI and generative AI. And I think they're pretty different. So most of the people in the room probably have an iPhone, which if you have a facial recognition, you've been using AI for quite a while. Lots of firms are using AI to improve processes. It's basically just can you teach a machine to recognize patterns and then create efficiencies related to those patterns. When I was at NDSU as a student, there was discussion of neural networks that was underway. And this is an advanced version of neural networks, because now we have the computing power and the technologies that operate at a pace that allow us to do the things that the theory at that time said we would be able to do. Generative AI is different in that it poses the potential of substituting for human thought. I'm a deep skeptic on that. I think we're quite different than anything that a machine can accomplish. That doesn't mean that machines won't accelerate our learning or create some options for us that we had not previously had. What we have told our staff within the company, and we have a generative AI work group that's experimenting with things, is that AI in and of itself is highly unlikely to eliminate your job. However, someone who knows how to apply AI appropriately may well replace your job. So I've always been a continuing education kind of a person, and I think that you need to be informed about it. I'll give you an example of how AI, bordering on generative AI, is operating in at least one large mortgage company in the customer service call center, and that is a place where I think you're going to see some jobs eliminated, is call centers, because the machines, you've all been forced to make your way through all the options on the phone, right? I say that lovingly. But it's going to go much further than that. So at this company, when an inbound call comes in, the person who's receiving the call is a person, but they don't have a keyboard. They have a conversation, and they have a screen in which the AI prompts them on the next question to ask, given what the borrower had said to the answer to the first question. So the machine actually assists them in following through the logic that the household is, or that the mortgage holder is discussing with the staffer. And it's increased their ability to be both more efficient and effective for both the borrower and the company in doing that.
Awesome. So could you go back to the second figure? The next one after this. Okay. So this figure shows the federal funds rate, the real federal funds rate on the left, and the federal funds rate is the rate that banks charge each other for overnight borrowing. It's the one that the Federal Reserve tries to set, and the real is subtracting out inflationary expectations. And so one of the things that I think you're trying to highlight in the figure on the left is that the federal funds rate since the great financial crisis the real federal funds rate has been negative. And so what are some of the implications of having a negative real interest rate, short-term interest rate for that long time period?
It's really, it's interesting. I had a lot of classes in economics, and I never had one that discussed the Federal Reserve setting the Fed funds target at a negative level. So the reason interest rates are positive and typically upward sloping, meaning the further away you go from today, the higher the rate will be, is that rates are designed to encourage you to forego current consumption in favor of future consumption, and those proceeds are used as investment by entities that want to increase output. So then if you reverse that, then it would suggest that what you're trying to do is incent people to increase consumption in the near term and forego saving and investment for the future, which to me is a pretty big departure from long-standing logic. And I think that we did run an experiment. I think at one point in the world, there were $17 trillion of sovereign debt that were paying negative interest rates. Wow. Now it's back to zero, which I think is normal. And I think it was an experiment that didn't generate a lot of useful results. So the interest rates near zero distort behavior in multiple ways. For one, an institution paying what might be normal rates, let's say a 10-year treasury of 3.5%, which means probably longer-term rates off of that might be at the 6 or 7%. If a company can borrow money and be profitable, repaying their debt, which is at a 6% rate or something like that, that suggests that they're probably a going concern in multiple economic environments. But during this period, there were some institutions who, if they had to pay 6% interest, would have been losing money and gone out of business. So you've encouraged a bunch of companies who were inefficient users of capital to remain in competition with other institutions that were efficient users of capital and therefore essentially wasted resources. So I think that's one example of malinvestment that's introduced by that. All right. So I'm doubtful that we'll see intentional deployment of that again anytime soon. And I think what I said earlier about believing that we're in a higher interest rate regime for some time would work against us seeing that anytime soon.
So one of the things just occurred to me when you said that is, do you expect a fallout? Some of these companies, I mean, or have we experienced a fallout of some of these companies that wouldn't have survived under the higher interest rates are starting to fail or will fail?
We've been watching that. Bankruptcies are up, but it's difficult to tell whether they're up simply returning to a more normal level after bankruptcies having been suppressed by the very low rate environment. But it's our expectation that we'll see some of that. In addition, one of the things that we have seen with both the Fed funds target and the 10-year Treasury being really at negative or zero interest rates is a significant amount of debt, particularly in the commercial real estate space, which is now underwater if it has to mark to market to current interest rates. And the banking sector is actually having to work through that. Particularly the regional banks are having to work through some of that.
Yeah, office space and with the work remote and everything, right? Okay, yeah.
Yeah, that's a whole additional
story. Yeah. So one of the things you talked about at the beginning was, incentivizing people to consume now. And so, are you surprised that inflation didn't pick up earlier doing this kind of policy? In my view, I think one thing that has not been written about is in the run-up to the great financial crisis, if you recall the antecedents of that, or the core of that, was that credit was broadly mispriced. A lot of it in the housing sector, but in other sectors as well. The price that was charged, given the level of risk that was in place, was insufficient. But there was, in the housing market, there was some tax incentives that generated additional business that would not, if the risk had been priced properly, would not have occurred. That generated incomes that would not have occurred, but those incomes being generated led to compensation for the workers, which elevated the entirety of economic activity on false legs. When the legs came out from under in the great financial crisis and people realized that there wasn't actually that level of actual demand for housing and things fell apart, what you had to see was a period for the unwinding of compensation that was above what would have been merited had risk pricing been normal. And so we saw the decade after that, from like 2012 all the way out to 2018 or 19, growth was very subdued over that time period, which from my perspective was resetting the excessive growth unsupportable by proper risk return metrics in the first decade. So that was underway while some of this was going on. And I think that tamped down inflation in that time period. Okay, what about housing prices? So I saw the Bank for International Settlements, they say since the third quarter of 2011 up until now, real housing prices, so accounting for inflation, have gone up by 70%, or the median housing price has gone up by 70% in the United States. Is some of that related to this, do you think?
It is. Did you want to go to the...
Oh, sure, yeah, sure. Can we go to the?
This is my favorite
Yeah,
chart.
yeah.
I actually have a T-shirt with this
Keep going.
chart on
Keep going.
it, just to show you how much of a
Keep
nerd
going.
I am.
This one.
Yeah, I told several audiences that I was going to make my staff wear this chart so they never forgot how the supply problem got here. And somebody in one of the audiences sent me 10 T-shirts with this on it. So what this chart shows is the relationship between price and profit in the house prices and the response of builders to that growth in price. So the orange line is the year over year. I'm sorry, the black line is the year over year change in inflation adjusted house price. And then the orange line is single family starts adjusted for population. So what it's showing is as price goes up, builders build. What a surprise. Builders are in the business to build houses and sell them and make money. So for almost 30 years, that relationship stayed very strong, very predictive relationship. And then we hit the crisis, and you can see both starts and prices collapsed in the crisis. That crisis laid the foundation for the supply problem today. So at the peak, we were building 2.2 million units of housing annually, 1.7 million of that being single-family detached houses and the remainder being apartment buildings. And it fell to 400,000 units and stayed at 400,000 units for 3 years, 3.5 years. So all of the difference between 2.2, the supplies and inputs that you need to build 2.2 million houses versus 400,000, that 800,000 are jobs that went away. And they went away for 4 years. So those people didn't just sit by the phone and wait for the phone to ring. They had to find work. So they left the real estate space. And you can think about companies that build PVC pipe and companies that build faucets and companies that harvest lumber and all of the things that go into a house. You destroyed 3/4 of the supply chain for building houses in that time period. It takes a long time to build back that supply chain, and we're still building today that supply chain back. If you watch the builders' surveys during that time period, for several years, like 7 or 8 years, the number one thing that they said that they needed most was skilled labor. So if every builder is trying to expand, they're all looking for skilled labor at the same time, and you had the number of people it took to build 700,000 or 800,000 houses, you took them out of the market. It's taken a long time to rebuild. So that's the collapse and why it was so slow to rebuild. So what's going on with house price? So you see in 2010, you see that little jump in the black line. So this will be on the quiz. That's a lesson in public policy. So in 2010, in an attempt to stimulate the housing sector, we passed a first-time homebuyer tax credit. But in a market where supply is inelastic, if you goose demand, you get a price response. So since you can't build a house instantaneously, it takes 9 months or maybe 12 or 15 months. If you suddenly shock the demand side of the equation, price goes up. Then if you eliminate the program, the price goes right back down to the fundamentals. So that's a lesson in public policy, that little jump. Yeah. Then you see this gap out between the price signal and the supply signal. Part of it is that supply can't respond that fast. I explained that. But the other part is the millennials. So in the fall of 2012, we survey 1,000 households a month. We've done that since June of 2010. We started that survey because of all the articles that said the millennials have learned the lesson of their parents. If you buy a house or you go into foreclosure, you lose all your wealth. So what they want is 300 square foot apartments with amenities. We did not believe that this one crisis had eliminated the American dream of owning a home. So we surveyed. In the first month, June of 2010, 92% of millennials said we eventually want to buy a house. But we figured out it's a good thing if you have a job. The industry attempted to make those loans to people who didn't have jobs, didn't work out that well. You need to have an income that comes with a job. You're probably going to get your credit in shape, and you may get a partner, or my mother would say, benefit from clergy, and then buy a house. So the millennials were saying, we understand what went wrong, and we're not going to do that. But that expansion was the most urban-centric economic employment expansion of any post-World War II expansion. And you don't build single-family detached houses in the middle of New York City or Washington, D.C. or Chicago. You build apartment buildings. So what they were wanting was the job. So in 2012, we put out a press release. We said the market has now turned. We're on the downside of the foreclosures. Then in 2014, we said, here come the millennials. And now what's going to be a problem is supply. People thought we were nuts after going through millions of foreclosures. But you see that gap in price, that's the millennials showing up on the demand side, and the supply side could not operate fast enough to meet the demand because the millennials are a bigger population group than even the boomers. And so that's why I love this chart, is once you understand the time references to it, you can actually see why we are where we are. And then you see out in the far right, you see the big spike that comes with the pandemic. If you were a household that had savings, were getting ready to buy, if you're a family of 3 and you qualified for all the programs that were made available, that was about $11,500 you could take in cash. If you add that to your savings, that's enough to make a down payment on buying a house. So you could look in every market, divide that market into thirds by house price, and in every market, the bottom third was appreciating the fastest of any of the segments in that market. So the pandemic, much of it went to housing qualified millennials who were just about ready. They all jumped in, and remember what I said about the inelastic supply curve, the push demand, price went up, and so you've seen the impact on affordability of that intersection.
Yeah, super interesting. So I think your cocktail parties, if you wear your T-shirt to those cocktail parties, they'll be a lot more interesting because then they can talk about
right
about
here.
your T-shirt.
It's right here.
Yeah. Could you go back? So you were talking about debt, and I think that's something we should talk about. And so could you go back to right here to this one? Okay. So the figure on the left, you're showing the federal budget. So you're showing, surpluses, deficits, and showing that there's a negative relationship between the budget and unemployment. So unemployment goes up, there's more unemployment benefits paid out, there's more welfare payments paid out because the economy is declining, less tax revenues. When the economy does well, more tax revenues, less of those other payments. And so it makes sense, and you show even data over a 45-year period that we've had really a consistent relationship. It's almost fitting a line perfectly, a regression line. And then you show, like, all of a sudden in 2020, we have this huge shift down. And it seems to suggest that even when things are going well, I mean, you look at when unemployment is low, we still have big deficits, like 6.5% of GDP, which is a huge deficit, kind of unprecedented. And so given this situation, it looks like it's going to be a lot harder to ever have a balanced budget, and especially with interest rates going up. So does this worry you at all? Are you concerned about this?
Absolutely. I have grandkids, and I care about what we leave to them as a legacy, as I'm sure many of the people in the room here do. The departure from that long-term relationship actually started in 2016. So we started running increasingly large deficits. You can see the line move away from that regression line. And then you see the pandemic and the 2 stimulus packages from the pandemic. But then you see we return to that path of continuing away from that long-term relationship. Now, all of that shows up on the right-hand chart with that the debt. On the left is the annual deficit. On the right is the accumulated debt. And you can see that we've been undertaking an accumulation of debt for quite some time, but you can see on the far right the very almost vertical growth in that debt most recently. And what's important there is the last time we saw something like that, we were fighting World War II. And this is in a time when the U.S. economy is growing strongly, that we're running deficits at the 6 and 7% level. It's simply, in my view, unsustainable in the long term. So I worry about that. Now, how do we fix it? Well, it will take political compromise in order to accomplish that. If you try to do it all by increasing taxes, you'll kill growth. If you try to do it by cutting things, there are people that are going to raise serious issues because, for example, Social Security, which will, if unreformed, will actually start drawing on general revenues within 10 years. A lot of people have treated that as a retirement fund, and so there's a lot of sensitivity, and both presidential candidates said they have no intention to touch it. So the more things you take off the table, the less you have to work with. Now, can it be done? Canada had a similar situation at the start of the 1990s. How did they fix it? Because they did fix it. They fixed it by changing tax policy to accentuate growth, and they had a bipartisan agreement on the expenditures to hold expenditures to below the rate of growth, so that they basically grew out of the problem. But the magnitude of the problem relative to what we have today was much less. So it's going to take, in my opinion, I think we're going to have to both raise taxes. If we decide to address it today, we'll have to both raise taxes and cut expenditures and put in place the focus on growing the economy. Because the faster you grow, the easier it is to solve the problem. So on the tax side, you have to be very sensitive to how it incents those entrepreneurs that we were talking about earlier, employment, those kinds of issues. So can it be done? Eventually, global markets will insist that it gets done. That, to start with the conversation that we started with on why have rates gone up, that's one of the things that you read in the market is that the bond vigilantes, that is, bond traders, are sending a message to the Congress and the White House that we think something needs to be done.
Yeah. So, and so I know that there's a lot of global conflicts and concerns about our military needing to be rebuilt. So, do you think we can tackle this and that at the same time, build up our military and also deal with this problem?
I think we will have to. One of the things that I think is often not explained as a benefit of investment in defense is that it lowers risk premiums for global trade. And we have a demonstration of that underway right today with the Houthis attacking the shipping in the Middle East. That has rerouted traffic, ship traffic down around the south of Africa, and added 23 days, I think, on average, if I got the statistics right. That's tremendous additional cost that's being put in place because of the inability, at least to this point, to suppress that through the military. So there's a benefit in military investment in reducing those global risk premiums. I think it's going to be called upon us. Partly, we're the one economy that is performing very well in today's market, so other countries do not have the growth that we have. We have commitments. Whether those commitments will get revisited or not, we'll find out in the coming days. But a lot of the world depends on us for stability.
Yeah. So we have, usually we want to have about a half an hour of questions from the audience, but before that, I'd like to talk a little bit about the North Dakota economy. So you have, there's a couple of graphs just showing agriculture, just showing crop production, again, crop production rebounding. But again, North Dakota is a leader in producing wheat, soybeans, sunflowers, durum, a variety of agricultural products. We're also a leader in energy production. Third leading producer of crude oil in the nation, and also a big producer of natural gas, wind energy, other types of, biofuel, other types of energy as well. So how do you think that positions North Dakota for the future?
Well, I think it's in a great position. In terms of exports, for example, both energy and agriculture are two huge components of U.S. exports. And I know in the first Trump administration, the embargoes caused some issues for North Dakota, but there were compensatory payments that were made to make up for some. I'm not sure about all of it, but for some of it. So I would expect that that will continue. Ag exports will continue to be important. The energy space, President Trump has said he intends to support the expansion of development of energy resources in the United States. So I think North Dakota is well positioned in that space. I think that politically, the state is well aligned with what's going to be going on in Washington. So I would think these would be pretty optimistic days for North Dakota.
Yeah. So you mentioned the retaliation for tariffs with the agriculture, and I think that's an interesting thing to think about, and we're thinking about headwinds for the future. It seems to me like there's kind of a consensus, unfortunately, that trade is bad, and I mean, it seemed, I thought that we had a consensus in the U.S. where most people were favorable towards international trade. Do you think that there is a emerging skepticism towards trade? I mean, is there anybody that, it looks like to me like both parties, both platforms were we're going to raise import tariffs and we're not going to allow free trade.
Well, I think there's three things to think about here. One is where security issues are concerned. That is in the manufacture of military equipment, cybersecurity kinds of things. Part of what you're seeing is an awareness that we still do have people that don't value the same things that the U.S. does and that do mean us harm. And so attempting to keep them from having access to the things they can use against us will be a part of the trade discussion. The second thing is that the tariffs, I think, are designed to adjust the terms of trade to, if you think about President Trump's, the map of his election in 2016, there was an academic at the University of Chicago that overlaid the votes over where the manufacturing jobs in the United States had gone from, and it was a perfect overlay. So President Trump had his finger on something that was very fundamental to households in a lot of the country, and that, in my view, that led to his election. He sensed that sooner than anybody else did. It's notable that when the Biden administration came in, they did not reverse the tariffs. To your point about whether people appreciate free trade or not, they did not reverse the tariffs that went into place, but in fact kept them there. A third thing that I would think about is that while, as economists measure the benefits between two countries, they can clearly demonstrate that free trade benefits both countries. But what is often not shown is how those benefits are distributed within country. And that goes back to that first point about where the manufacturing jobs were lost. So it's one thing to say, on net, the country's better off. But if you've lost your job, it's not a compelling argument to you, right?
Yeah, no, that's true.
So I think part of what may be the strategy is that and President Trump likes bilateral debates on tariffs, is an adjustment of the terms of trade to bring back some of those good-paying jobs to the United States by thinking more about the internal distribution of things, not just the cross-borders part. That's Doug Duncan's point of view. That's why that disclaimer was up there earlier. I don't know if Fannie Mae shares that point of view or not.
That sounds good. So just one last thing I want to ask you about before we go to the audience, and could you go to the last slide, please? That's it. Yep, thanks. So the Conference Board has a leading economic index that includes a composite of 10 indicators that is supposed to predict what's going to happen for the future of the economy, and it's been pretty accurate in predicting recessions historically. And they say that they show in this chart here, whenever there's a red line, that means that the leading economic index has declined by 4% or more in the previous 6 months, and at least half of the indicators that they include, which there's 10 of them, so at least 5 of them have declined in 6 months. They say when that happens, we oftentimes usually enter recession. They're predicting recession, and you see that even the small 2001 recession, it predicted accurately, predicted the great financial crisis. COVID, I think, is not, that's kind of a different thing. But then you see that they predicted a recession in February of 2022, that there was this peak and it started declining, and they predicted a recession with this. You talked about the yield curve previously, talking about the fact that we expect long-term interest rates on treasuries to be higher than short-term interest rates. And when it's inverted, we have long-term treasuries lower interest rate than short-term, that's an inverted yield curve. That usually predicts recessions. They found an inverted yield curve at the same time, again predicting recession. So has there been a change and fundamental change in our economy do we need to change the leading economic indicators, that this isn't working anymore? What are your thoughts on that?
That's a great question, and the answer is yes. So let me take 2 parts. As we were starting to emerge from the COVID, I instructed staff that I didn't want any text, as we wrote about forecasts, to use the word normal.
Oh.
Because I don't know what is normal in the post-COVID time period. The second thing is, in order to find normal, you used to have some rules of thumb. Here's 2 rules of thumb that you just cited, and they no longer work. So I'm in a group of corporate chief economists that meets periodically, and I run a survey of them before we go to the meeting on a series of topics. Not the most recent meeting, but the previous one, I surveyed and asked, do you believe that the traditional indicators of what constitutes a recession, indicators when a recession is coming, have been disturbed? And if so, do you no longer, or are you reworking your models? And the answer, about 50% of the people in the room said they don't believe that those indicators are predictable. So the other thing that we have done is, and I don't know whether Mark Palin, who is succeeding me as chief economist, will continue this, but I said I want to see a lot less comparisons to 2019, because it's not clear to me that if the structure of the economy has changed, that referring to 2019 is of any assistance.
Yeah.
So let me give you one example of the dynamics of that might help illustrate how to think about other parts of the economy. So on the day that your boss, or if you're a boss, you told your staff or your boss told you you could work from home, that day you had a real increase in your disposable income, because that commuting cost was translated into income for you. If the boss tells you you have to come back to the office, now he or she is telling you you're going to take a pay cut. So it's really not surprising that people would resist coming back to the office. Now, but there was more to that transaction than just that. Implicitly, you agreed you would provide your own workspace in the house in return for being able to work from home. So now, over time, that could cut the production cost from the company that hired you, although right at the moment, they still have leases or own property, which are now sitting vacant, right? So they have to rationalize that cost. They're gonna compare, are you as productive working from home as you were working in the office? Because if you're not, then they have to adjust your pay over time, and you may or may not like that. On the housing front, the question is, does the house, which was previously a residence, now have another attribute which changes its value, that is, it's a workspace? And so you should necessarily expect to pay more because you're not just getting a place to live, you're also getting a place to work. So if you start thinking through those things, you'll quickly see that part of the reason the regional banks, which are heavily invested in commercial real estate office space, are being devalued is because that's the owner of the company's problem to solve in terms of their financials. So you can see there's lots of little components of change in economic relationships that have to be rationalized, and that takes time, particularly the measurement of productivity. And what we've seen at Fannie Mae is no one can be required to come to the office unless their job, not them, but their job is specifically identified as always in office. Everybody else, with a small exception, are hybrid, meaning they can be encouraged to come to the office but not required. And there are a few jobs that are permanently remote. It's the job. If the person changes, that job is still permanently remote. That's one strategy, but I can tell you the productivity of the different work groups within the company is different depending on whether they're at home or in the office. So that's still being sorted through. So when you ask, are these indicators still valid, that's seriously open to question whether they are or not.
Oh, yeah. A lot to think about, very interesting. And that also just, I mean, we could have this discussion later, but I just think it also, a question that comes out of this is, is the city going to be viable in the future when you're talking about, these big offices that are vacant and people being able to move further away from the city because maybe they commute 2 times a week instead of 5 times a week, and they can get a bigger home for less money further away from the city center,
Exactly, and that we can see, we watch the migration behavior. We can tell if you have a loan that ultimately Fannie Mae guarantees, we can tell the location from which you made your application and the location of the property for which you made the application.
Oh, neat.
So we can actually track your the migration patterns, and we can see that. There was a move out, now there's a move kind of halfway back. So if you only have to go back to the office 2 days a week, you're willing to work, to live a little further out, take a little bit more of a commute on those 2 days for the privilege of working at home 3 more days than you originally were able to do. It also leads to other issues like in daycare and parent care. I mean, there's all kinds of things tied to it. It's actually very interesting.
So just, do you think the city is going to be what it once was?
I think it will eventually, and part of it is because of the huge amount of immigration that we've had, and immigration tends to migrate towards cities, which helps businesses because of a concentrated labor pool where you can sort for skills in a small area. The search costs are lower, and so cities have some significant advantages. So there'll be a period, I think, of adjustment of relative values, and then I think you'll start to see the cities pick up again, dependent on them being safe.
Yeah, okay, awesome, yeah. So I'd like to ask if anyone has a question from the audience. Oh, I'm sorry, could you come up to the microphone? Because it's on Zoom as well. I'm sorry, it's my fault. I didn't know where the microphone was.
spoke of a city of a certain size having an inherent advantage of attracting more employees. Is there a size that you look at, 250,000, 500,000? I mean, are cities in North Dakota large enough to meet that criteria, or are you talking major metropolitan areas that have that advantage?
Oh, there's a tiered effect, I think. You have the very large cities, New York, Washington, Seattle, that we could see clearly the impact of the COVID on the lockdowns and the mobility of households in those major cities. But some of that migration took place to second tier or third tier, where tiers are measured by size. So for example, Louisville, Indianapolis, Tulsa, places like that saw significant outmigration because there's still universities, healthcare systems, things like that that are accessible in those communities. Fargo, I would say, would be sort of between a second and third tier size-wise. So there is a certain core of services and amenities that people are attracted to cities through. And I think the degree to which they will benefit will depend on the services and amenities that are offered through those areas. Traditionally, immigration in the United States has come in through 11 gateway cities. And as you would imagine, they're mostly coastal, but Chicago is the one inner city that, center of the country city that has benefited from that.
Okay, you can just go ahead up to the microphone.
In a recent Wall Street Journal op-ed, Larry Fink from BlackRock said there was $23 trillion in cash sitting on the sideline. One, do you agree with that figure? And two, is it short-term interest rates keeping that money on the sideline? And if that's the case, what else could help get it out of money markets and deployed in capital markets?
Well, he probably knows better than me, given the kind of institution that he runs, on what the actual dollar amount is. I have been watching Warren Buffett, who's a pretty sharp investor, convert things to cash. He has a lot of cash in the hundreds of billions today, so that's certainly part of what Fink is talking about, I have no doubt. One of the questions I think about the stock market is how much foreign money has come into the U.S. stock market, simply because the U.S. economy has performed so much better than any other economy around the world. And so if you look at norms, to go back to what's normal, price earnings ratios, the various metrics that people use to try to understand whether the market is fairly priced, overpriced, or underpriced, they're all pretty close to all-time highs. And so that does raise questions about where does the cash get deployed. Some of it's certainly being deployed in the bond market because all of these U.S. treasuries that are being issued are getting purchased, and domestic purchasers have been the biggest purchasers of those securities. So I've seen a couple of commentaries suggesting that that aspect of things looks a bit like Japan, which ran a debt level at 250% of GDP, and yet while they didn't have any growth, they also didn't collapse as a nation, but it was partly because that debt was held internally to the country. So whether that's going to be a benefit, all that cash will be a benefit and find its way, part of it, into the bond market remains to be seen. I think in terms of your question of where I think rates will go, you'll hear the discussion about what's a neutral rate of interest for the Fed funds. My personal view is it's in the 3 3/4 to 4% range, which is about 100 basis points higher than what the Fed seems to be targeting if you look at their summary of economic projections. But to me, it relates to this question of the debt. And if there is an addressing of the outstanding debt and the annual deficit levels, I would expect those numbers to come down closer to where the Fed currently thinks.
Hi, Doug. Earlier we were talking, we were talking about how, well, one of your charts said that part of the problem, or well, maybe the problem with housing prices is lack of supply. And there are a lot of us that are locked into low interest mortgage rates, and but you mentioned a method that people are using to get around that, and I thought that was pretty intriguing, as far as basically, you know.
Yeah, I was referring to a speech I gave at the American Institute of CPA's Bank Accounting Conference. That's where I told that bad joke that we started with about the accountants. There were about 1,000 people in the room, and I asked, how many of you have a mortgage at 4% or lower? And about 3/4 of the room raised their hand. I said, now, how many of you, if you were required to move, would keep that house and rent it out because the rent cost is perhaps $1,000 over what the mortgage payment is, and you would use that rent to subsidize the mortgage where you went? And about 3/4 of them raised their hands. So one thing that is likely to happen is that you will see this huge, about 60% of all mortgages that are outstanding today have a mortgage rate of 4% or less. So that's a lot of millions of households, and you will see a significant part of that converted into single-family rentals.
Then you also mentioned our perception of the rental market is that it's all apartment buildings, but it's really not.
Yeah, well, it is one, yeah, we were talking about the distribution of places people live. And the only time at Fannie Mae that I've ever asked to take ownership of a different unit that wasn't currently mine was, there was a separate research group in the multifamily or apartment lending business. And I asked to merge that into my group because I said, if you think about housing the way people do, they start in their parents' home, they maybe move to the basement, and then they probably move to a college dorm or out into an apartment with some friends, and then eventually they get married and they rent a house for a little while, and then they buy a house, and then they buy a different house, and then maybe they downsize. So there's this cycle of behavior that people don't think of, oh, that's single family and that's multifamily. They just think about their housing. So the distribution of homes in the rental space, about 50% of them are 1 to 4 unit properties. So a 4-unit property is a fourplex where the owner lives in one of the 4 units and manages the rent of the other 3. Single-family house is just any house that any of you might live in, rented out. That's 50% of all the rentals in the United States. Then the 5 to 50 unit apartments are somewhere around 24 or 25%, and the other 25% of these large apartment buildings that you see. So people have a misimpression about the structure of rentals in the U.S. housing market. There's been a bunch of political turmoil about institutional investors buying up single-family homes and keeping them from people who would like to be owner-occupants. But that's 4 big firms, and they own 4% of those 16 million single-family rentals. So it makes good headlines, but it really, in terms of a factor in that market, it's not really what the headlines would imply.
There are other people with questions.
Dr. Duncan, Gary Pressler. You started out when you were talking about interest rates probably will take longer now to come down, and you just talked about a neutral rate. And I think, I'm going to suggest to you that, the time period that we had up until 2022, 15-year time period where Fed fund rates were 0, interest rates were near 0, that people think that that's normal, and to me, that's the anomaly. I mean, 0 interest rate environment is not necessarily good for the investors in commercial paper because they're not being rewarded for the risk, the added risk they're taking on. Has a tendency to create housing bubbles because it affects the price of the home as they go up. And so I think a lot of people think we're going back to that type of a rate environment, but I think from what you're telling us is that there is a neutral, there's a balance between the borrowers and savers, and we may not be that far off from it right now. And I think that's what I'm hearing you say. Is that right?
That is correct. If you look at the 30-year fixed rate mortgage from, let's say, after World War II, when the VA was fully operational, up until about the year 2000, the average 30-year fixed rate mortgage was 6%. So they're a little bit above that long-term average at the present time. You're absolutely right. A 0% interest rate is destructive in many ways in terms of the risk-reward trade-offs that we think are important in making a market economy function. So yeah, we're not that far from it. If we decide to get serious about the debt, the deficits and the debt, then what I'm telling mortgage lenders is if we allow the cycle, if housing goes back to having a cycle, which I believe it will, that I would think of a rate environment of somewhere from a low point of 4.5 maybe to a high point of about 6 with a median of about 5.25. That assumes a growth rate of between 2 and 2.25% in GDP annually. That 6% mortgage occurred while the U.S. was growing at 3%, including recessions, was growing at 3% in that pre-2000 time period. So I think the question really gets back to the debt and the deficit that we were talking about. What kind of an impact does that have on the underlying rates?
Change it a little bit and give you a real life experience of what the tariffs and what wage inflation has done for housing prices. And in September of 2021, we were going to build a home. And we got the plans all done, we got the builder lined up, had all the subcontractors submit their bids. And at that time I said, you know, the housing market is soft in Bismarck, and I probably should consider selling my existing home first. And so we waited. And then in April of 2021, we went back and decided we're going to go ahead. And so a year and a half later, exact same floor plan, nothing changed, exact same subcontractors, they just revised their bids, 20.7% higher in a year and a half. And it was Canadian lumber tariffs. The lumber prices were just bouncing all over at the time. Steel prices, and then wage inflation. The framers, I mean, they thought they're going to be nailing a more expensive 2x4, so they need to have more pay. You know, their salary doubled, and that's exactly what was happening. And so, you know, we looked at it and we said we still want to go ahead and do that, and so we started. And when we finished the house, 15 months later, it probably would have cost us another 20% now if we would have started over. So the housing prices have just escalated and just went crazy. And I think that's, you know, our area because of the economy we have with oil and the housing and stuff like that, something to do with it. But it's also a nationwide issue, I think, from the standpoint of the housing prices just getting away from a lot of people to be able to just afford a basic home.
Yeah, I live in Southwest Florida in Cape Coral, which the kids there call it God's waiting room. Again, don't come to our cocktail parties. But prices there rose 40% over a 2-year time period. So part of it was lack of supply. Part of it was the build supply. To your point about lumbers, I was trying to build a house at the same time. I finally crashed the project because I couldn't get the commitments that I needed financially from the builder, which I understood the builder's problem was trying to find qualified labor, and lumber prices were all over the mark. So all of those things came together with the inclusion of the Fed as part of monetary policy, buying and still being the biggest single holder of mortgage-backed securities in the world. So the Fed actually intervened in the market in the cost of credit, and part of the that lock-in of interest rates and the very low interest rates, which allowed households to bid more. So if you think about, set aside interest rates for a moment, let's assume a cash economy, an individual household with a certain income can roughly afford to pay 3 times that income to buy that house. It's a rough rule of thumb. If interest rates are higher, then they can afford to pay less. If interest rates are lower, they can afford to pay more. So when the Fed lowered rates to the 0 10-year Treasury rate, mortgage rates down to 2.5% to 3.5%, a lot of that went into the bid for houses that existed, and because supply was short, it dramatically drove up price. And so monetary policy had a role to play in that as well.
Hello.
Hi.
Thank you for the thoughtful comments on the national economy, Mr. Duncan. I have a question regarding tariffs, inflation, and technology. While I'm optimistic Trump will help, his trade policy will help us grow out of the deficit, he's mentioned tariffs of up to 60% on foreign goods. He has intentions to incentivize manufacturing domestically through tax cuts. Keeping in mind your chart of technology being a deflationary force, advancements in AI and automation powering modern manufacturing, do you think this deglobalization and trade policy will cause inflation to trend higher than the Fed's 2% target?
Thank you. And I appreciate that you write your question down, because I have a great memory, but it's short, so I write mine down too. I think that the evidence is clear that tariffs are inflationary, with the proviso that if it is a sort of an instantaneous one-time change in the tariff, that's more of a price level shift as opposed to inflation. Economists measure inflation as the rate of change in the general price level. So the change is the issue. We're talking here about a price level adjustment in the tariff. My personal belief is that one of the strategies is to use tariffs in order to reindustrialize the United States to some degree, particularly in essential security-related fields. So if you think about the chips that are developed in Taiwan and the threat to Taiwan from China, one of the reasons to domicile chips, even though it might be uneconomic from a pure free trade perspective, is for security reasons. So I think you'll see some of that. I actually think President Trump likes bilateral negotiations, and there's some wisdom to that, in that the location of where the industries are that are of concern varies from country to country. That's some of the specialization or access to resources kinds of issues. So, and it can be clearly shown that costs go up to consumers, whether the incomes of those employees in the industries that benefit offset the loss of purchasing power from the increase of costs to the rest of consumers, is that we go back to that question of how the benefits and the costs are distributed within a country in the terms of trade with another country. That's helpful. Yeah, well, one of the things that is a misunderstanding, I think, about the United States is that we don't manufacture things. Actually, the value of manufactured output from the United States is the highest it's ever been. It's just that it's in very specialized areas, and the compensation in those areas is actually quite high. It's also very energy efficient per unit of output. The energy usage that in the U.S. manufacturing sector, I think, is the lowest that it's ever been. So I do believe that we're very good at applying technology to processes to make them more efficient. both in resource use and in output and in productivity. And to the extent that it doesn't displace labor, the labor compensation goes up with it because those workers are made more productive by the importation of that technology. So I think that's, I continue to be a bull in terms of market assessment about the value of technology investment. I think there's plenty of room to run.
Okay, thank you. So just one last question, and this is a question that we ask of all of our Menard family distinguished speakers, and we usually have students in the crowd, so I'm asking this question, but we do have students that are on Zoom, so that's why I'm asking this question. So you grew up like a lot of NDSU students. You grew up on a farm in Fergus, or near Fergus Falls, and you've been extremely successful in your career. So if you were to give some piece of advice to students about what they can do to be successful in the future, what would that piece of advice be?
Well, I might pass on what my dad told me, which was work hard and keep your nose clean, by which he basically said focus on the work that's in front of you. And I think that's, my career was an unexpected career. I never anticipated being a chief economist of anything. But I've always had a predilection to try to understand what is true. And it's hard work working through all of the things that could sort of cloud your view to try to get to that. And so the first thing is work hard. The second thing is, I think when I was working on my doctorate, they told me correctly that a PhD is 99% perspiration, 1% inspiration. So I'm no smarter than anybody else. My staff can tell you that. They can confirm that. But I think learn all your life. So work hard, learn all your life, because the world will continue to change, and you need to understand that. And hang around people that are doing the same thing, working hard. It's always been one of my things from a management perspective, is that A people hire A people, and B people hire C people because they fear them somehow. But if you surround yourself with the best people that you can find, it lifts you right along with them.
That's great advice. Thank you. And let's all give a warm round of applause. Thank you. Thank you for doing this. It's been awesome.
Thank you for the invitation.
Yeah, thank you.